Hey YouTube, welcome back to my glorious hovel. Uh, I wish I had a screen or something to put up back there, but not right now. Maybe later I'll get around to it. I wanted to talk to you today about a stock, KBWY, which is the Investco KBW Premium Yield Equity REIT ETF. And what that is a exchange-traded fund that is composed of equity REITs, which are companies that own and rent real estate. Now, I do, in fact, own shares of his stock. I plan on getting more. Don't plan on selling any unless I have to for an emergency, but I do like the stock a lot. Here's the 5-year chart. Pardon me. Okay, first off, the yield right now, the current yield is 9.44%. Now, a REIT has to distribute 90% of its income. That means it basically exists to pay you money. Okay, it's not a growth stock. It's more of a fixed income investment, even though it's a stock. Okay, and this thing is yielding 9.44%. Now here's the 5-year chart, and you can see that basically the highest it was 38.36, and right now it's at 23.53. You see here at the height of the pandemic that I don't understand is it says the 52-week range was 13.50 to 25.43, but that must have been a spike because on the chart here shows on March 1st it went down to 16.57. So that was probably an intraday spike, a spike during the day, or maybe even like a one day, whatever. It's kind of the main number is $16.57 that it traded at as a low March 1st of 2020. Now before that, it was up in December of 2019 rather. It was at 31.21. The highest it's ever been right here is 38.36. So it has in fact gone down some. However, it went down because of the pandemic. Now it's up to 23.53. And let's look at the performance, and I'll show you. It's really not horrible. Okay, the 10-year total return. Now this is with your dividends reinvested, okay, but not putting anything in. That's if you had just opened it exactly 10 years ago and you had never put another penny into it other than reinvesting your dividends, you would have only made a 4.41% return. However, if you look at how you have all these dips and things, you can see that you would have bought it over the years. You would have bought it at a lower price several times. That would have improved your return. And of course, the main reason the return is horrible right now is because look where the stock price is at. Hopefully, that stock price is going to recover, and if it recovers, it's going to look way better. Because then your total return, this 9.44% dividend, will be reflected in the total return. Now, just for a comparison, let's look at VNQ, which is kind of the gold standard, if you will, for REIT ETFs. Now, VNQ also invest in mortgage REITs, which are companies that are basically loan companies. They hold mortgages. Okay. They don't necessarily originate the loans, but they hold the loans. They own the loans. Okay, and you can see that it has really been pretty flat, although it's pretty much recovered from its high. See, it was at 94.30 back here, October 1st of 2019. Now it's at $91.62. So it's pretty much recovered, but it only yields 3.80%. So that means this whole time that you've been holding it, you will have received a much lower dividend. We're going to, that's just making the assumption that the dividend pretty much stays the same. I know there was a period of time when it was lower, and there was a period of time when it was higher. It's going to fluctuate. Okay, but let's look at the performance, and you'll see that now they show a much higher 10-year total return of 8.19%. But like I say, that has a lot to do with the fact that the price has recovered. That if the price if the price of KBWY recovers and V&Q doesn't go up further, KBWY is going to beat it. And the fact that you're buying it right now when it's low is going to help your return too, as opposed to buying V&Q when it's high. It's just something to think about. It's not as easy as just looking at these numbers. You have to use common sense about it. And we're going to compare it to the Global X Super Dividend REIT. Okay, that thing, you can see it stayed pretty much around the same. Peaked out at $15.65, but right now it's at $9.53, and it went down to $6.57 on March 1st. I didn't mean to do that. On March 1st of 2020. That was apparently a bad day for real estate. Now, it yields 8.01%. So that's a little more than 1.4% less than KBWY. Okay, looking at the performance, it doesn't have a 10-year return. Apparently wasn't around back then. For a 5-year return, they give 2.10%. And that's with dividends reinvested. And a lot of that, like I say, that's going to have a lot to do with the fact that the stock's kind of in the toilet right now, frankly. Will it recover? Hopefully it'll recover. It's kind of odd, perhaps, that V&Q recovered, and these higher yielding stocks haven't recovered as much. But you have to realize, too, that one of the things that determines the yield is the price. Okay? The lower the price, the higher the yield. So, obviously, if you're going by yield, you're going to want to hold stocks that haven't recovered in price. That's going to give a higher yield. Like I say, you have to think about these things. You can't just look at the numbers and take them at face value. I believe, it's my feeling, that because of the difference in the chart, okay, this one was pretty much not that much variation, where you look at KBWY and it had more variation, okay, over time. And I feel that the returns probably would have been better. In fact, even the numbers bear that out. But I think the returns would have been better because you would have been buying more low. Now, a bit too about stock price. If you're not planning on selling, the stock price isn't all that important. Uh, it matters, but I'll give you, for instance, okay, let's go over here. Let's look at SPY. Just look at SPY. Okay, S&P 500. Okay, S&P 500 index. Oh, look at that. For 5 years, it started at 206. It's at 394. I mean, that's really good, right? I mean, you've made a whole lot of money. However, you look at your dividend yield, and you're only yielding 1.5%. Now, we'll say that the stock's almost doubled. Let's say you had bought it back here, okay, and you were looking at the dividend, getting the dividend. You had bought it back here. Let's say you were still getting 1.5% back then. Okay, that means now, since the stock price doubled, based on the money that you invested back then, that money you invested back then would now be returning you 3%. Wow. In other words, income-wise, you'd be in the toilet on this one. And the thing to remember is that, you know, you can have a market crash at any time. Market crashes are going to affect all stocks to a certain extent. But and this, a lot of people, myself included, think that we're in for something horrible to happen. Okay, because these companies, the S&P 500, they, you know, the price has gone up here. It went from 257 on March 1st. March 1st, you should remember that date. That's the date when apparently stocks hit their low point. That was a really bad day. It went from 257 on March 1st to 394. March 12th, 21. So it's, you know, a little over a year. That is a, do it in my head, I'm gonna say it's like a 40%. Well, okay. You're gonna make me do this, aren't you? Okay. It was what, 257 divided by 394. Okay. It's up 65%. Okay. 65%. But like I say, the dividend, if you were just trying to live off the dividend of this thing, if you had invested this, you would be really not happy. Now, of course, you can say, well, you could sell this and you could buy shares of KBWY to start reaping the dividend, and that's entirely true. You could do that, but would you? You know, a lot of people would look at it and say, "Oh, I've made all this money. This stock is going up. I don't want to get rid of it." You know, a lot of people lose money in the market because they don't want to sell. They want to buy when it's high because they have they're positive about it. They have a positive outlook on the stock. But then when the stock goes down, like when it went to this market, this dip here, okay, let's say a lot of people, they bought it at 321 January 1st, okay, when it was up high. And it went down to 257. So it lost over $50. Why did I do that? Okay. It lost over $50. A lot of people would have sold it right there. Boom. They would have locked in a loss. And then if they would have held it for a year, look where it went to. Okay. There's a lesson to be learned in that. But like I say, it just depends on how you want to invest. For myself, remember, this doesn't reflect the reinvestment of dividends. Okay. Now here, 10-year return with reinvestment of dividends, 13.31. But again, remember, most of that is going to be stock appreciation. That's not going to be actual earnings that you received. Okay, their earnings were reinvested into the company. If the company goes bankrupt, you lose that money. The money's gone. Whereas that money that was paid out to you, if you had held on to that money, you still have your money, don't you? So, the choice is up to you. I mean, myself, what I'm doing right now is I'm reinvesting my dividends, and then when I retire, I will live off the dividends. I won't have to mess with anything. It'll be fine just the way it is. Anyway, that's my review. KBWY, kind of giving you the high points, the low points. I like it, but I'm not going to tell you to buy it. I'm just saying it's it's a popular stock right now, and that's just kind of my outlook on it. I have a positive outlook on it, but remember, I'm a doctor, but I'm not your doctor, so don't take my advice. It's just for entertainment and education, whatever. And I guess I'm going to put an end to this video, and have a good day.